our COBT listeners and viewers, it's Maynard, Mike, and Jeff here with a gift right in the middle of earnings season. I don't know, Mike, is it the middle? Can I say that? Is that technical?
Early innings.
Early innings. Okay, Mike Bradley says early innings. But seriously, a real gift, a good friend. James West is joining us. He's the managing director and head of energy and power at Melius. We got to know James years ago when he was at Evercore, and so we're delighted to have him back in his new capacity. And James, thanks so much for joining. But really, as I was looking at you commenting on what's happening with various companies, various sectors, various trends, this just felt like an absolute opportune time to have you join us. So thanks so much.
Yeah, happy to be here.
All right. Well, Mike, I assume there's nothing going on the screen, and you want me to just go straight to Jeff?
Yeah, just go straight to Jeff.
Yeah, okay.
All right.
Good. There you go.
But seriously, look, I mean, this is going to be a very interesting week, obviously, from a bond market standpoint. We had the FOMC meeting, which is happening Wednesday. Right now, the base case is the Fed is not going to raise rates, but there's some concern that they actually might. So Wednesday is going to be a big day. And if they do raise rates, I think, the interesting aspect of that is just listening to Warsh's post-meeting conference, because he will definitely be in the crosshairs of President Trump if that happens. So big meeting on Wednesday. So the market will be focused on that. As far as the broader market, the Dow's up roughly 700 points today. S&P's up 0.5%. And that's essentially just because oil prices have come off. I mean, here in the last couple of days, there's been a lot of volatility. We've talked about this over the last couple of weeks. There's a lot of sector rotation. You have semiconductor stocks getting beaten around. A lot of that money is moving into industrial stocks, and a lot of money is also moving into Apple. Apple just joined the $5 trillion club this week. As of companies that are reporting this week that a lot of people are going to be focused on, you're going to basically have Microsoft and Meta on Wednesday and Amazon on Thursday. So clearly, everyone's going to want to see what the CapEx spending looks like for those three companies. My guess is it's going to go higher. We'll see how the market reacts. As far as oil markets, we already talked about this. Brent crude is down about $13 so far this week to $83, and WTI is down about $11 to $78 a barrel. And obviously, they're on and off. What's going on with the Iran war. I wouldn't want to make any bets on where this is going over the next week. I mean, obviously, markets right now are assuming the best. We'll see where things kind of fall out. As far as the energy sector, James is going to be honest with today. We'll maybe talk about some of the oil service and IPP stuff. But as far as just oil services so far, it's really been the big three oil service companies and a couple other names, Liberty, people like that, Oceaneering. And I think generally the net, it's been a net positive. I mean, most of these companies have had good earnings. International has been good, sort of the Middle East. But I think maybe one of the disappointing things is that, North America, the frac market has not been as great as people were hoping for from a pricing standpoint. It is going the right direction, but probably a little bit disappointment on that end. As far as this week, I note two things. The U.S. oil majors are going to be reporting, so there's going to be a lot of focus there. But I think refiners, you got Valero, PBF, they're going to be reporting. So there's going to be a lot of focus on those companies to kind of give a read on what's going on with global product markets. And my guess is they're going to talk about a secular growth market going on there. Be prepared for that. We'll see how things go. So with that, Maynard, back to you.
Jeff, before we jump in with James, anything on your mind?
Tie in with what James talks about today, particularly on the power market. That's been such a powerful theme. And so much of that driven by, the AI-oriented CapEx spend. So it's not surprising, as that theme's cooled, you're seeing some of the power market cool off. But it's going to be interesting to me because, we went from, not a lot of names exposed to merchant power and new power generation to whether it's SPACs or regular way IPOs, a lot of new names. And, many of those are now trading below offer price. So it just creates, interesting dynamics. I think second to that is one of our core themes this year is we'd probably go from peak growth sentiment around power to start more execution phase. I wouldn't say that's happening today. It's still trading more uniform. When people are optimistic, the whole group goes up. You're seeing a lot of them all pressured downward. But I'm curious to hear James's view as we go through today. It just feels like whether it's this year or we're going to be entering a sorting function where there's more winners and losers, within the theme versus the theme, broadly driving all the performance.
Awesome. Well, James, I stand by my comment. This is a perfect time to have you. I was looking at the history. We had you when you were at Evercore in October of 2022. Like, wow, what a world of difference this time has made. That's where I wanted to start is catch us up on you. You moved, you're at the new firm, you got the team, different approach, but a lot of the same topics. But catch us up on James West, the person, before we get to James West, the analyst.
Absolutely. Happy to do that, Maynard. Thanks again for having me on the program. First off, what we're doing at Melius is, I think, very differentiated, and certainly the market environment and what we talked about in October of 22 is very different than the market environment of today. Back then, we talked a lot about clean energy and how companies were taking oil out of their company names and changing the names of the companies to not be associated with what people described as kind of dirty energy, and the energy transition mantra was in full force. That's kind of gone into the background here. But what I had learned from covering clean energy along with the oil services at Evercore ISI was that the analyst model has changing and is an outdated model at most firms. And so at Melius, it's a little bit of two things. I'd say one, we're kind of getting the band back together. Our founder, CEO, Scott Davis, who covers multi-industry, and Rob Wertheimer, who covers industrials. They founded the firm 10 years ago, along with Scott Weiss, who's the president and runs sales. We all worked together at Barclays and many of us at Lehman Brothers. So we knew each other. We've been talking for the last decade about getting together and doing this. And so it really shouldn't be too much of a surprise that we did get back together, because we loved working together the first time. I think the second thing is that when I covered clean plus oil services, it was really looking holistically around the energy and power markets. Oil and gas and power were converging very rapidly. We saw that as a major theme. We saw electrification as a major theme. We also saw natural gas in the age of gas kind of emerging as well. And so I said, look, I want to cover this much more holistically. We want to cover the majors. We want to cover the relevant E&P companies. We want to still cover the big oil service companies, which I'm known for. But I want to cover the IPPs as well, because they're going to be incredibly important in this AI data center build out. And eventually we'll probably cover midstream. We'll probably cover metals and mining, some things in that area, as well as we kind of branch out. Everything is up for grabs here. But they had been very successful, both with Scott Davis covering multi-industries, obviously covering just everything. But they brought in a guy named Ben Wrightsey on the technology side, who we had also worked together with at Barclays previously, who was really Mr. Apple, quite frankly, in the early 2000s. He was the hardware guy. He was well known for that. And he'd gone to Melius as a banker and came back in and said, hey guys, I'd like to get back into research. This is 4 years ago, roughly. I'd like to get back into research, but I don't want to be just the hardware guy. I want to be hardware through software and cover everything. And they said, great, that's how we think about the world. That's how we think about the analyst role going forward, and how you can support your clients is by covering every different vertical and having a view on the different subsectors of the different industries you cover. And he also said, hey guys, I think AI is going to be big. And this is 4 years ago. This is before ChatGPT came out. They said, okay, cool. What's AI? So fast forward, it's becoming extremely important. And now we work very closely with the technology team, with our industrial team, with our multi-industry team, because the energy and power stack, as you know, is a big part of the AI stack, and is really the impediment to AI right now. It's getting power into the market to power these data centers is what's holding kind of the progress on AI. So that's kind of the overall view of Melius. And I'm actually right now sitting in our new offices, our new global headquarters here in New York City that we just moved into 4 weeks ago, I believe. That's why there's nothing on the walls yet. I do have some deal trinkets and stuff around my windows, but I haven't done, and I have my Schlumberger overalls over there. So,
Right. Well, that wall, James, it's like begging for us to send you like a Veritan poster or some logo or something. I mean, that could be big.
absolutely.
I think it's probably, I was thinking about it, Jeff used to run research and then capital markets at TPH, and Mike was buy side and then sell side. So it's probably and I always loved research as a banker because I just love the people in research in particular. So, but it's really interesting to think about it as a business. Most people don't understand how these things are constructed, how they make money, the different approaches you can take. So the fact that Melius, you might just expand on that a little bit because it is a different model. And again, maybe this is professional hazard, but it's kind of interesting to hear about.
Yeah, I mean, the model, because we are just research, there's no investment banking, there's no trading. So we make money via research, via the institutional investor votes or certain payment agreements and arrangements that we have, but it's for intellectual capital. So what we're selling is our intellect, our management team relationships, our views on the market, are the fact that we're talking to everybody engaged in the market. And at Melius, we engage with about 96% of the actively managed assets in North America and some percentage in Europe. But it's primarily, you can think about it as a North American business, but we're talking to all the same people we talked to when we were at Barclays or Lehman or Evercore ISI. So the clients don't change, but the model has changed. A lot of big investment banks, they use the research department to really fund the investment banking operations and to help the bankers. And that's why it's very siloed. You have your vertical, and that's your fairway, and you cover a bunch of stocks that, quite frankly, investors just don't care about. But you're doing that so that they have coverage. The CEO thinks that, hey, XYZ investment bank loves me because this analyst loves me, and so this banker gets this deal, and it funds the higher margin part of the business, which is really the investment banking business at the big investment banks. We are not that. We basically have said, look, we think the importance of what we do is our intellectual capital. We think we should be paid appropriately for that. And we think that we can provide a service. Now, if I can't help you make money in the market, don't work with me. But that's my goal, is to help you make money or not lose money in the stocks that I cover. That's the goal of everybody here at Melius, which is a much different goal than most research departments.
So the other thing you said that's interesting is a little bit of how we think about it here at Veriton is instead of specializing in a vertical and obsessing with every single name in an entire vertical, you've got I'll lovingly call it the Cheesecake Factory. You have a little across many categories, but that helps you really understand the macro. So the fact that you've added IPPs to your more traditional coverage group, that's an example. But that model is pretty unique.
We think so, and we're very proud to have this model. And you can't see it from this vantage point, but the new offices do have a fair number of empty offices because we're in growth mode. We think this is the new model going forward.
Well, okay, that concludes the Melius commercial on TV. but no, but it is really. I mean, you have a lot of followers, and so I think just understanding what's going on with you is definitely a place to start. Let me throw in, and then Mike and Jeff jump in here. Earnings and IPOs, those two jump out. These earnings calls, they're always fascinating because there's these tidbits about things are at different stages and what's happened and who's spending what on CapEx and who can build what, to Jeff's point, who's actually going to make this stuff happen. And the IPO market has been really strong. And it's pulled a lot of companies in. Now, some of them are below the IPO price. Talk to us about those two things just to kick off. What you've been learning so far in earnings season and what you make of the IPO market over the last 6 months or so.
Absolutely. So I think, at this point, we've heard from the 4 largest kind of diversified oilfield service companies. We also heard from Liberty, one of the strongest fracking and power companies in the United States. And generally speaking, the results were very positive. Obviously, you have the issues in the Middle East, but revenue came in above expectations. Margins came in a little bit maybe light, but overall the company's beat. We also saw some big moves in SLB and Weatherford and Baker Hughes. Halliburton got beat up a little bit because they talked about the fracking market in the U.S. is not seeing the pricing that you guys mentioned earlier. And so I think what we're seeing is a real cycle developing, particularly in the international and then the offshore markets. I think you'll see a lot of things. One is companies need to rebuild inventory. So you're going to have a structurally higher oil price going forward. Two, refinery utilization is at very elevated levels of 95% in the U.S., 80% globally, but we have refinery outages in Russia and other places. And so we're seeing product prices that are going to be also elevated for longer periods of time. And so I think we'll see when we get to the majors on Friday, Exxon and Chevron, I think you're going to see some pretty big beats on the downstream parts of their businesses because of that. But I think, thirdly, the CapEx spending cycle for 27, 28, 29, in the end of the decade really has risen. The outlook has gotten better. We see a better environment for oilfield service companies. We also see, of course, higher cash flows from majors and E&Ps, but we think that it'll be primarily international and it'll be really broad-based. Latin America, West Africa, certain parts of the North Sea, certainly Asia and Asia Pacific and India. And so we think that a good cycle is coming. I think two, what we've seen from the service companies is, electrons are now a revenue stream. It was oil and gas, now it's electrons. So they're getting into power in various different ways. Some guys are getting pulled in, like SLB got kind of pulled into the data center play, but now they've got a JV with Liberty that also has a power business. You have, of course, Halliburton has ownership in power companies. Baker Hughes has repositioned the company around natural gas and really industrials. And because of that, they're sitting in the fairway of what's going to be the biggest driver of power, which is natural gas. Natural gas, we think, is an AI vertical. We've said that many times. But I think that because it's the first thing we can get, companies are gravitating towards that. So it's not renewables necessarily, although some renewables will be involved. But natural gas is 40% of power consumption here in the U.S. But we think that number, that percentage will go up. And we also think that the last thing maybe I'll talk about is behind the meter is going to be much, much bigger. The regulatory environment in the U.S. is just too archaic. It needs to be broken. We need more or less regulations. We need more entrepreneurs out there. We need more IPPs. And that's why we cover the IPPs. We think they're the biggest beneficiaries of this growth, of this 200 to 300 gigawatts of demand that we have coming by the end of the decade for AI data centers. We need the IPPs to provide a lot of that infrastructure and a lot of that power. And you're already seeing that. You see it with Chevron and GEV and Microsoft, but you're going to see it more and more with many different companies in many different ways. The market's evolving and moving around the regulatory utilities and going to the unregulated parts of the market. And that's obviously why your home state of Texas is getting a lot of attention, because you can kind of do what you want in Texas.
Oh, no, that might be the phrase for our episode. You've already had a good one. Natural gas is an AI vertical. I threw in the IPO market. I made the first question too much, but what do you mind just touch on that, and then Mike, please jump in.
Yeah, so I think with the IPO market, I mean, you have some really big ones like the SpaceX. You've had some that are companies that maybe weren't ready for prime time, but they had electrification drivers, and everybody wants to get into the AI stack. And if you think about the AI stack, what's the biggest impediment right now? It's power. And so if you can't get power, you can't energize, you can't run your semiconductors, you can't run your AI, right? So that's the biggest impediment by far. And I actually am a believer that some of the concerns, and you guys highlighted it as well, the concerns about CapEx at the hyperscalers and the platform companies, CapEx will continue to go up, but it may not go up as much as people are forecasting right now, because there's no reason to spend on semiconductors if you can't energize. So if you got a year or 2 or 3 years before you can energize, you can wait because you can get semiconductors within 3 to 6 months, whereas you may not be able to get power behind the meter power for 2 years. And of course, to get on the grid, that's a 5 to 7 year journey, which of course is why the market's coming back and going behind the meter. But the IPO market, I think it got a bit frothy. I think we saw some people positioning around SpaceX, but you have to really, at some point, you have to come back to reality of there's not a lot of cash flow, there's not a lot of earnings, they're burning a lot of capital. And so when interest rates start to move up, which they've the market's been doing that, you take companies that don't have an earnings profile, don't have cash flow, don't have free cash flow, and the valuations come down. It's just a natural market event. And so I think a lot of companies came in with these higher valuation levels, and the market, of course, has taken those down.
Yeah, James, one of the words you said at the beginning of your discussion was convergence, and I completely agree with you. There's convergence going on between traditional energy and the electricity business, and if you're a CEO in either one of those businesses and you don't realize it, then you're probably missing a boat.
Yep.
But instead of maybe talking about that, I'd like to kind of talk about, you're talking to two different investment bases, right? Investor bases, right? You got one on the IPP side, electrical type, traditional electric investors, and on the other side, you got the oil services and the oil majors. Maybe talk about how difficult that is to cover both of those different investor bases, where there's maybe some something, I don't know,
Sure.
where they diverge, where they come together. Just kind of give us an idea of just both investor bases and how what you're doing is really tailored to both of them.
Yeah, so when I was back in my Evercore ISI days, when I covered clean energy, that was kind of the utility electron guys, and I covered oil services, that was the oil and gas guys, and they were separated. As we've developed our new profile here at Melius, and we've been in the market now for over a year, talking about energy and power as kind of a combined and converging market. What we're seeing on the buy side is some convergence as well. Now, certain firms still have silos, but a lot of firms, they have to understand both. The analysts and the PMs have to understand both. And we're talking a lot more to PMs than analysts, because we're obviously at Melius, we're not chasing the old II vote that you did at a siloed firm to make sure you got II ranked. We don't care about that. I can't eat II dollars. And so I care about how do I help this portfolio manager understand what's happening in the utilities, and understand why it's important for oil and gas and how it all links together. And we're seeing conversions on the analyst side as well. There's really only, I think, 5 or 6 firms out there that have a dedicated oil service analyst. The guy that I used to pound with phone calls and emails and make sure that I got my number one vote from them. Those don't really exist at most firms anymore. The buy side is evolving as we're evolving. So I think we're a little bit ahead maybe in some cases, and maybe with some firms we're just keeping up with them, but the whole market's evolving, both sell side and buy side. So I think it's a different environment now, and I think of course AI has kind of just consumed everything and made we don't even need to know. I don't just need to know about oil and gas and power. I need to be able to understand, hey, what is AWS's numbers or Google's numbers and their CapEx numbers, how does that relate to my industry? So I need to know tech as well, and then industrial also for cooling and other products that they sell. So it's a big convergence of 3 major, I'd say the 3 most important categories in the market right now are the tech companies, really includes the AI companies, the energy and power companies, and the multi-industry / industrials.
Yeah, and I'd also like, and maybe a question. Obviously you've covered the IPPs, and it's like these companies coming in vogue. I mean, it's like the IPPs a couple of years ago were just everyone had to be in the IPPs. Everyone had to be in sort of Constellation because it was a nuclear company. And then it was in the last 6, 9, 12 months, it's distributed generation and sort of large generation companies, and some of the wind's been taken out of the sales of those companies. I mean, so it seems like there was a lot of euphoria. Who are the people that are actually, are the generalist investors? Who is buying these names? Who is sticking with those stories through, sort of thick and thin now?
Yeah, well, the good thing about the IPPs for me personally was when I showed up and said, hey, I love this model. I think you're going to go from what was a very volatile business to a very highly contracted business at much higher pricing levels and contracted cash flows, and you'll become infrastructure type companies. And they said, we love you. the the utilities analysts don't think about us that way. They know these cycles have ended in tears, and they think we're at inning number 9, and you're saying we're at inning number 1. And so let's talk. You got access right away. That was fantastic. It did help that several of the IPPs are run by ex-oil and gas company executives, and so we can talk barrels and electrons, and so we've known each other for a long period of time, for well over 20 years in some cases, and so that helped. You have seen a movement away from maybe the pure IPPs into more the electrification behind the meter type of stories. But I think that's really a temporary phenomenon, because the IPPs can go behind the meter too. It's not like NRG doesn't have land and slots at GEV for turbines, and it's not like they're not going to announce deals for behind the meter projects. They absolutely are going to. You're going to see that with Vistra as well. You're going to see that maybe with Constellation. In the nuclear theme, while it got a premium for a while, my sense is that premium is kind of eroding somewhat, because quite frankly, the hyperscalers want power and they don't care where they get it from. Now, they're not going to announce a coal-fired power generation contract, but they will, as you saw with Microsoft and Chevron and GEV, announce a natural gas project. And, they'll come in with carbon capture over the top to get back to their clean stories, or clean energy stories, and their net zero targets. But remember, the net zero targets are 2040, 2050. So you got some time in between where the AI race, they went from being, we're a sustainable company, we care so much about the environment, to we got to win the race. And quite frankly, they all think that AI is really a winner take all game. I don't actually agree with that, but they think that, so they're kind of price agnostic on power, which is kind of great for the IPPs.
Kind of staying on the kind of investor oriented thing, what is the most debated topics? Kind of, is it the duration of this growth cycle in power? I'm just curious. We've seen such big swings both ways in some of these stock prices. So I'm just curious, from a fundamental standpoint, as you're talking with the portfolio managers, what feels like either the most controversial or most debated topics?
Yeah, I think the most debated is, can the regulatory environment evolve to allow the utilities to benefit from this, or is it going to go to more of the distributed power companies? And we think PJM is going through a process right now. They've got some major changes coming that FERC is kind of forcing upon them that will happen this summer, and I think we'll see a flurry of deals announced probably after we get that regulatory certainty, which is imminent. ERCOT, you have the moving from a one-off grid connection approval process to a batch process. That's intended to speed up the process. They want to approve a multitude of projects rather than one and then one and then one, and keep it slow. And so that batch process will kick off here in the next few months. So both of those things, those are the two biggest power markets in the U.S. That will clear kind of the regulatory debate. I think that kind of goes away at that point. And then the secondary debate is, well, are we going to overbuild? And I think because the regulatory PJM market especially has gone through some machinations which have led it to reduce the amount of capacity that it thinks that it needs, the generation capacity that it needs. I think we've shaken out kind of the loose hands. So the guys that put themselves in the queue but weren't building anything, and maybe didn't need it, they're kind of gone. So it's naturally evolving to where what gets built will probably already be contracted. So the overbuilding aspects that has been part of the merchant power business forever, we don't see that evolving the same way this time. So I think I'm a cyclicals analyst. I don't want to say it's different, but it feels a bit different on at least the merchant power side of the equation. Those are probably the two biggest debates. And then with the oil gas side, the debate's the oil price. We were, 6 months ago, we had too much oil. We're going to be swimming in oil. Oil was at 70 going to 60 and then to 50. I think that debate doesn't hold weight right now. I think we've taken out a billion and a half barrels out of inventories. We're going to be at 2 billion at some point if we don't get this situation in the Middle East concluded. But we're going to have to rebuild inventories. We're going to have countries that produce oil and gas, but also import. They're going to want to drill more in their own home countries for energy security reasons. And I think, broadly speaking, the structurally higher oil price, whether it's 75, 85, 95. We think it's in the 80s, but that's our view. Whatever that is obviously good for really the industry and not that bad, honestly, for the consumer. Shale is the greatest thing for the consumer ever. We had a great run, but now the energy companies have to eat.
Curious, James, as you were ticking through some of the stocks and some of the sectors and some of your outlooks, a lot of these things are happening a few years out, right? Like we're going to build facilities that will come online 27, 28, 29. Nuclear is beyond that, but same concept. The service companies will have a structurally better market where we're, doing a lot of things to find more oil. But as you went through almost all of those themes, they were out in the future.
Sure.
And what every public company deals with is how many people own their stock who are not thinking about what 27, 28, 29, 30 look like, but yet we have a lot of equities levered to things happening out in the distance. So where do you notice, I guess there's two questions. Where do you notice investors really impacting strategic choices because they're more short-term oriented, if you will? And when investors are patient about what's to come, who are they and why are they patient like that? And then is all of this contributing to a much more volatile market where whether it's interest rates or sentiment, you're debating things that are happening years away. So it's just a constant, okay, now it's not happening. Yes, it is happening. Actually this company won't be there. Like there's an interesting public market here with a lot of stuff weighted years in the future.
Yeah. I mean, I think, Maynard, when you're going through the biggest change in the economy since the Industrial Revolution, volatility is going to be part of that. We're rebuilding the economy around AI. You have an administration that is all in on AI, all on energy and power as well, with Chris Wright as the Secretary of Energy, who I know you know well and I know well. But I think that that creates inherent volatility. Every new model release that my colleague Ben Wrightsies has to talk about with investors is the one that beats the other ones, and it's game over on AI. Day one. And then a week later, another one comes out and they won. And so the volatility around that is just enormous. And then it's what do investors want? As interest rates bounce around, as we have a new Fed chairman who, while is a Trump appointee, Trump has told him you're sure Fed, and he may or may not do what Trump wants him to do. And we're in a period where there's concerns today that he's going to hike this week. Now, I don't particularly think he's going to do that, but that's my opinion, and I'm not an interest rate guy. But as rates go up, you create inherent volatility in companies that are there to make a ton of money in 28, 29, 30, but they don't have that cash flow now. Well, the discount rate changes and impacts valuation. So I think that you'll see more volatility, or continue to see the volatility that we're seeing until we get into that more structured, contracted cash flow. And so my opinion, services is a great area because that's the CapEx cycle is coming in 27. And in fact, if we clear the conflict now, the urgency of Middle East producers is so high to get their market share back that they'll be, production work first, of course, but then they'll be drilling new wells, and you'll see a CapEx explosion there. And so, service companies clearly positioned well. I think the IPPs, I mentioned the regulatory stuff. As we get through that this summer, I think they get more contracted cash flows, and I think that kind of stabilizes what is their earnings outlook. And then, of course, for the E&Ps, as we figure out what that new oil price is, you're going to look at companies that have just tremendous cash flows, companies that have, they took the pledge back when Doug Terreson came out with it, and the buy side helped us at Evercore ISI to kind of get them back to things like capital discipline. They have very clear goals with their assets and their portfolios, and they're not going to deviate. They're not going to spend like drunken sailors. Unfortunately for my service companies who love that when they do that, it won't be that way for the majors or for the E&Ps, but they'll have this cash flow profile that we can model out. And so I think, at some point we stabilize, but volatility for now, because the economy is changing, more stable, more stable cash flows, more better valuations, quite frankly, as we go through the next probably 18, 24 months.
So when you talk to investors and they say, um, I'd like to be exposed to all these great trends, but I'd like to dial down the volatility. So can you expose me here? But I don't need all the upside because I'd like to avoid the downside. Like what's a reasonable place to wait out this market in your world, over the next year or so?
You look at companies that are executing extremely well, that have exposure to lots of different parts of the value chain, and that's the major oil companies. So that's Exxon, who wants you to think of them as an industrial. I do remember 15 years ago when every industrial wanted to be an energy company. So these cycles come and go. But that said, Exxon, you have to say they're executing at the highest level and they are resource rich. Chevron as well. And then I think with the global gas theme, Shell actually is really well positioned at this point. Great transaction with ARC recently, but a lot of this was set up with the BG acquisition, a decade ago or so. And so it's setting them up to be the global gas provider in a role that needs natural gas everywhere all at once. And so I think the majors are probably your safer type of areas. It's not missed on me because I've covered oil services for 26 years that oil services is volatile. You're going to get the volatility. I always like it when I used to work with a pure utilities analyst, they'd say, God, my stocks are up 1% today or down 1% today. It's a lot of volatility. I'm like, that was my morning. Now they're up 5 or they're down 5. So services are more volatile, majors are less volatile, but they have all the same themes. And I think the IPPs will settle over time. But if you really want to take a utility view, you don't have to go with the IPPs. You go with NextEra. Go with the biggest. They got the Dominion acquisition that's going to put them in some DOJ hurdles for a while here. But if you want to own the best run, biggest, baddest utility, regulated, mostly regulated, then some deregulated parts, but that's the one to own.
Curious what you think about, you mentioned you're, largely a North American business from a investor standpoint. How does Canada fit in as, how you think about the US and Canada together, how you think about Canadian resource, how you think about, Canada is just a good place to be over the long haul?
So we love the oil sands producers. Low costs, consistent production, high cash flows. So those make a lot of sense. I think you still have, even with some pulling back of the energy transition mantra, and with Mark Carney I think he's still more willing to to say, look, we need to be a resource. Alberta has tons of resources. We need to monetize those resources. We need to, unlike the former prime minister who said it makes no sense to sell LNG to Asia, even though all of us can look at a map and say, actually, it does make a lot of sense. I think he's willing to do that. And we see Canada phase 1, Canada LNG phase 1 is already happening, and Canada phase 2 probably gets FID'd by Shell later this year. And so we see a lot of potential. Plus, they have a lot of hydro in Canada as well. So you've got oil, you've got natural gas, you've got hydro. Why are we not building more data centers in Canada? Makes a ton of sense to build data centers in Canada or near the Canadian border and taking advantage of that energy that they're producing. There's the back and forth between the current administration, the Carney administration on trade and tariffs and all that kind of stuff. This is a lot of political theater. The natural economic incentive for Canada and the U.S. is there. They're our biggest trading partner. That's going to continue. They're going to be even bigger in the future. They'll sort out a deal.
You mentioned in oil and gas and service that, a number of years out, you just see a lot of international activity.
Yeah.
What do you think about shale inventory, shale technology, AI extending the life of shale? Like, how do you think about the lower 48 from a production standpoint, particularly after 2030 or so?
Yeah, so I think a couple things there, Meredith. One, on lower 48, I think shale is, we're going through a maturity part of the cycle, but I think we can hold production at pretty high levels because the AI is getting better and better. The wells are getting better and better. I mean, I'll take EQT because they've already reported, but or they've already talked about the quarter. But I mean, just when you thought EQT couldn't drill a better well, they did. So, I mean, it's just enormous what's happening here with a lot of these companies and the ability to leverage new technologies. And so I think it's got a runway. That said, the most exciting areas are probably outside the lower 48 at this point. I think the Vaca Muerta with the Vaca Muerta Sol coming on and the export capacity for LNG, the export capacity for oil is a big driver. You've got a government that's proactive. Even if the government changes, everybody understands how important energy is, and the whole volatility of Argentina kind of goes away. I think in in the UAE, shale activity there, they want to produce more EOGs over there. EOG's taking shale technology there. And then you have shale technology being applied in Australia as well. Maybe not the most supportive government in Australia today, but that said, they've got a lot of resource and they can probably make it work. So we're watching around the world where there's some more interesting emerging plays that can take that first 10 years of shale where we were kind of toying around with everything and we try to figure out how it works. They can leapfrog that and get to almost where we are. I mean, we're still in Argentina. There's still the cost is still maybe 20% higher, and some of that may not be able to go away just because of lack of infrastructure and things like that. But we're getting closer every day to where the U.S. is, and the U.S. is obviously optimized significantly for shale.
Yeah, James, you earlier talked about, two of the areas that were really hit upon, especially on the oil service side on Q2 earnings, was essentially what international looks like, specifically in the Middle East, and what North America looks like. But one of the areas that came across to me as like probably the most bullish over the next year, maybe next 2 or 3 years, is offshore. So maybe talk a little bit about what's going on there, how you see that playing out here over the next 12, 24 months.
Yeah, I think as we've kind of rejiggered portfolios, I think the companies have figured out that look, offshore is now, because lower 48, the quality has gone down. Offshore is now the low cost barrel. And so, and particularly in deep water. And so a lot of these deep water plays that have been discoveries that have names, so they're not new. We're going into development mode. The rigs are being contracted. They've been contracted. They're starting to turn to the right. That will increasingly happen over the next several quarters, and you'll see a ton of activity on these rigs and in these plays. And then you've got exploration coming back, whether it's Libya, offshore Israel and Greece, parts of course Namibia, for example. Exploration's coming back. Suriname. In the Caribbean. So it's a lot of exploration offshore that's happening. I think that'll lead to discoveries. AI is going to take kind of that dry hole opportunity kind of off the table because we're going to get so good at exploration. We're already getting very good at exploration, but AI is going to make it even better. And so I think we'll find more oil in more places. And I think offshore is really the place to be. So, you can play it a couple of ways. The big asset owners like the offshore rig companies, or then you take a company like SLB that dominates services on offshore rigs. We had a few clients that went to a Chevron event when they went out to Anchor a couple of weeks ago, and they're newer clients or newer people to energy. And they said, I couldn't believe how many Schlumberger guys were on the rig and Weatherford guys and Halliburton guys. And I said, well, yeah, that's the labor. The oil companies provide the money, and they target the resource, and there's one guy for them on board that's called the boss, but everybody else is the service companies.
The backdrop kind of across your coverage, whether it's the growth in power, the need for more oil and gas production, it's a constructive backdrop. But within your coverage, what are either the themes or areas you're either more skeptical or more cautious about over the next 2 or 3 years? Not tomorrow. I don't really care what's going on with earnings, but just in general, where are you either a skeptic or more cautious?
Yeah, I mean, we're certainly skeptical that North America ever really shows the same inflections that it's had in the past. It's just too consolidated. The companies are too conservative. It's a bunch of major oil companies now. You don't have as many independents that will just drill. I mean, look, Diamondback will drill, no doubt about that. So I think that's one area where we're saying it's not really an area we're focused on, and it's honestly why we haven't launched coverage on many of those stocks that are just levered to that market. Is we just don't see an opportunity set for North America. I think that, the other area that we're skeptical on is pricing for natural gas. We're big believers in natural gas as a demand source, but it's really easy to produce gas in the U.S. And I know there's been some controversy over the last week and a half with a podcast, and a very good friend of mine who was on the podcast, and he made some comments. And this is a guy that does his work, so I'm not in any way suggesting he's not right. I just have. I believe that it's easy to produce natural gas, and we're getting better and better at it every day. And so I think the infrastructure can meet the demand. And so I don't see gas prices really going to exponential type levels. Now, do we need to be above $2.50? Yeah, we need to be at 4 or 5 to incentivize that type of drilling activity, and we're not there right now. So I think the gas will go up. I don't see a $10+ gas environment. It's not the old days. Jeff, when you and I were getting in the industry, and we had to track hurricanes in the Gulf of Mexico because gas would jump $5 if it became a Category 1, and $10 it became a Category 2. It's not that way anymore.
I was wondering, you said up front you might pick up a couple of mining companies, or you just made reference to that sector. What are some gut impressions of that sector? Because, just to throw it out to lead the witness a little, it seems like, there are obviously some huge mining companies that have been around for a long time and are very levered to classic commodities like copper, et cetera. But then there's this craft industry around rare earths, which has a lot to do with national security, has a lot to do with government support and contracts, and so that's a very different feel. But how do you think about mining? How will you approach it? What's your sort function on that?
I mean, we're in our early days there, but we're going to do something there. I don't have my bookshelf like you do behind me. It's on the floor here. I haven't put the bookshelf up yet, but some of those books I can see that are around kind of electrification. I have too.
James, you got me wondering what the heck we got back there. I better look. We had a picture of Mike up there from last week's show, but that's a whole nother story. So
Gotcha. Okay. So we're going to look. I think the critical ones, certainly platinum, copper for electrification, platinum for electrolyzers and other things, nickel, titanium are big ones that are here in the U.S. And then I'll take another mineral, but uranium, domestically sourced uranium is going to be important, because as we haven't talked about it, but I mean, we see nuclear coming in a big way. This renaissance is real, both in the U.S. and in Europe. And we can debate whether SMRs, we got 40 SMR companies out there. Not all of them are going to survive. There's going to be a handful that survive, but is that the right way, or is it large scale nuclear? I mean, there's debates on both sides, but when we get into 2030s and 2040s, I think we're not going to be talking about as much natural gas as we're talking about today to power things, but I think we'll be talking more about nuclear.
I'm glad you mentioned nuclear, because and Mike, this has helped me with the facts, but this year has had a number of nuclear IPOs where within the week they're trading down. And so that's and I don't mean to, broad brush the whole sector, but there has been at least a number of instances like that. What do you make of and that's obviously a space where things are definitely out on the horizon. What do you make of that space as a space for public investors? Like, why is it suited to it? Why is it not? Like, how do you think about that?
I think it's difficult right now. My contacts at MIT will tell me I'm wasting my time with oil and gas, that everything is going to fusion in 10 years. Well, they said that 10 years.
We did a fusion show. It was fantastic. So we really learned a lot.
I met with the fusion company last week. It's incredibly insightful. I think it is the future, but unfortunately, we've been talking about it's 10 years away for probably 60 years. So I don't think we're there yet. So I think public market investors need and want cash flow. They want earnings. And so it's hard to underwrite that future earnings in an interest rate environment that's going up. I'm not sure it's the right vehicle, quite frankly, to be a public company. I understand you want capital, but I think there's plenty of capital out there for nuclear in the private markets. And so I think it's better to kind of stay back than come in at this point. But that's my opinion. But I obviously don't have any bankers to feed. So
That's funny.
I
Well,
put it wrong.
I was struck by it though when you said that, because it gets a little bit circular, because sometimes I think one of the reasons why you can attract the private capital is there's a public exit.
Yes.
So, so well, we've covered a lot of territory. When you think about all these spaces, are there nooks and crannies or pieces of the puzzle that people aren't thinking about that they should be? What's an under-discussed, kind of similar to Jeff's question, what's an under-discussed topic in this?
Yeah, I think, and I don't know if it's totally under discussed because Fervo had an early successful IPO, but geothermal. We took the 30,000 wells or so, or 30,000 wells. So we drilled in the U.S. and the learnings from that on shale, and we applied it to geothermal, and now geothermal works and it makes sense. It's economic, and Fervo is proving that out with almost every single well that they drill. There's a lot of others behind Fervo that are trying to do the same thing, and a lot of utilities are interested in that because it's a consistent baseload source of power, and they can sell that, of course, to data centers, and who wants baseload. So I think geothermal is an area to keep an eye on. I'm an advisor to a company that provides some information around geothermal, to full disclosure, but they have really unlocked, or they're showing what are the tier 2 and the tier 3 acreage for geothermal, particularly in the U.S., is now available as more like tier 1. It's not as hot, but because of the success in horizontal drilling and fracking, we can actually get to those resources at a reasonable cost level. And so that could open up other areas. So you don't have to just have geothermal in Utah, Nevada, and California. You can move it to other areas of the country.
For public companies, there's always decisions that have to be made, capital that has to be allocated. There's all kinds of things they have to figure out. And then they have to figure out communicating with their investors, and what's the right way to, what's the right timing, in terms of their thinking. There's no need to spook them if you're not going to do the big thing you're thinking about. On the other hand, you don't want to surprise people. But are there any observations? I'm just thinking a lot of public companies will watch this. What do you advise them about communications in an era which is very volatile? When you think about a lot of things where things change a lot, there's a lot of opportunities. How do you think about managing your shareholders in all this?
Yeah, well, the one other good thing about Melius, because we're not a broker dealer, is I can consult as well. So there's my commercial for the public companies.
That's 2 Melius commercials in the same podcast.
Might need my expertise. Look, I think that one of the most undervalued roles in the market is that of investor relations. And we actually, Scott Davis wrote a big report about this, I think 2 weeks ago. I'll send it over to you guys to make sure you have it. And I can send it to anybody else that wants it, but it was extremely well read. But we make the point that you really do need to focus on your messaging. You need to make it clear. You need to make it concise. You need to understand what it means in an AI world, because a lot of people are going to digest whatever the AI thinks. So you got to, your press releases, et cetera, have to be written for Claude or ChatGPT, whoever's going to read it before the analyst even gets through the press release. And so I think it's an important role. I think it's going to be, it will continue to be one of the most important roles. I think we've got a lot of good ones in the industries, in the companies that I cover. And there's some that, maybe could do some work on that. But I think you definitely want to make sure that your message is clear. It's got to be clear. There can't be any uncertainty around that, because the market, as you guys all know, the market hates uncertainty.
James, maybe this will piggyback on Maynard's question, but you've been in this business as long as I've been, and Jeff has. I mean, I remember when energy as a percent of the S&P was 12, 13, 15%, right?
Yeah.
And now we're at 3%, and half of that 3% is Exxon and Chevron, right?
Right.
I guess when you talk to investors, you essentially have a 1.5% market you're looking at. For investors, for that additional 1.5%, assuming their market weight, what are they looking for? Are they just looking for subsector exposure? Are they looking for size? Or are they looking for differentiation?
So I think it depends on the investor. Certainly, there's people that just say, "I'm just going to own Chevron or I'm just going to own Exxon, and I'll call it a day." And by the way, that 15% wasn't that long ago in our terms. It was in our lifetimes. So, and my bet is that we will go back to those levels because it's so important now for the global economy and for AI that we will see a reversion. And even going from 3% to 6% would be a huge move in all these stocks. It's just a massive move, all that buying power. And hopefully we can go to 12 or 15 and become incredibly relevant again. But I think they're looking for is they step out of the Chevron Exxon conversation. They're looking for who's not going to hurt me, right? Who's not going to blow up on me? So who has a clear view, who has a clear strategy, who has the portfolio, who's executing well. So is that, Baker's portfolio right now? Obviously a great portfolio they put together. Or is it Schlumberger who's going to be the leader here in the OFS cycle that is on the come? But it's bigger companies. It's not smaller companies. It's not the ones that can be, highly volatile because they can't hurt their portfolio in that 3% with that 1.5% weight in some stock that's too volatile. It's just too much of a risk to them.
Kind of underlying that, it feels like, it's probably partly where we are cyclically, for that other 1.5%, it's a risk mitigation. It doesn't sound like it's playing for the home run. It's playing for like a double, my mindset. And as we wrap up, I was curious to bring it back to Melius structure and just how you organize the team, because I do think, what you guys are doing is so valuable in terms of, being multidisciplinary, trying to put the pieces together. At the same time, you don't have some of the, frankly, busy work that comes with, covering, the whole laundry list of companies. What does the team need to look like, from a process standpoint? How do you build it so that you are sharing that information across each other, across the landscape? What do you do differently there than you would have done back at Lehman Brothers?
Well, the pie for us, right, is not some artificial bonus pool that you remember your days at the big banks, right? You go into the year meeting and they say, equities was up this, but we lost money on silver trading in Singapore, so the bonus pool's flat. You're like, again? Like, I didn't do that. Somebody else did that. Hurt them. And so you're flat, right? We don't have that. We're growing a business. We love it. We're all running our own businesses. But we know we have to work together to make this successful because industries have converged so much. And so, the offices right there, the office right there, but we're all together here in New York City, which helps. So we talk all the time. We share ideas all the time. And plus, because we're not a broker dealer, for the first time in 25 years, I can own energy stocks. I'm not restricted. So I can invest, I can trade my PA in things that I know about, but it's brought a bigger sense of all of us here, even the young guys who don't have that much, money, that they're trading their PAs along with our ideas. And so we're all invested in each other, in the knowledge base of each other's industries. So I'm trading, Ben writes these stocks around. I'm trading, not every day, we have day jobs, but we're investing in each other's ideas, which naturally brings us closer in the information sharing.
I was struck by you mentioned the new office in New York City, and we're all watching New York City. We grew up; it was the financial capital of the world. It still is. What do you think about New York City and it being the global financial headquarters? Is that a little bit? There's the Texas Stock Exchange. There's Mamdani. There's a number of angles around this question. But what do you think about New York's future, James?
So. Well, don't buy an apartment here anytime soon. You're going to get extra tax. Not only that, they're going to actually share with the public your address and your name. So, which he just did, which is incredibly dangerous. I cannot believe this was allowed, but it
So this is if you're an out-of-state real estate holder, they're going to share your name.
Well, they got it wrong. Actually, they actually put some people in there that your New York residence is actually their primary residence. But these are all the apartments they think they can tax. at that pied-à-terre level. They also changed it. So it's $5 million for an owned residence, and then they had it's like $1 million value for co-ops and certain other things. So they're actually hurting the working class too. So it's a complete chaos right now. That said, this is a moment in time. This is was frustration around prior administrations, prior governance of the city. The city goes up, the city goes down. We've seen this before. We need our next, solid mayor, maybe Bloomberg, 2.0, someone like that, to come in and really fix things. I think that we're going through a process where, it's like every 25 years, we got to try socialism for a little bit and remember why it failed and why it always fails. And so we're going to watch it fail again. It's going to get a little interesting in the city. I totally get that. But I think as a financial capital, we still dominate kids' dreams, right? Entrepreneurs, people that want to work in finance, people that want to live in the big city, Big Apple, they still come here. They still have big dreams. They still want to make, money, be part of something. I mean, there's so many people out there that want to be in the center of everything. And so they're going to come here. They're going to come to Manhattan. They're going to try to live in New York City. Not everybody makes it, of course. But I think that New York will come back. So we're in a little bit of a decline right now. I think we'll come back, but has it spread out? Sure. I mean, we've seen the rise of Texas as a home. We've seen the rise of Florida as a home for finance. And so, I don't think we're going the way of London by any means. We're just declining every day. I think we'll still retain New York, still the capital, but maybe it's not the same capital that it was when we were getting into the business a long time ago.
Well, thank you for that, because I know it was a bit of a departure, but it was really interesting. And it's also on theme. I was looking, I asked ChatGPT, when is the mayoral election? So we got to make it till November 6th, 2029. But just one more thing that's a few years out. It's part of our theme.
Yeah. Well, they're going to set up the 5 free grocery, or not free, but cheap grocery stores, the communist grocery stores soon. So we'll have some more data points in the next couple of months here on how that's going.
Well, thank you for being so wonderfully outspoken on this. I mean, we needed a real opinion. Now we know who to call.
Yeah.
James, you're a good friend. We appreciate it. Congrats on the new role, and look forward to staying in touch and keep on reading your stuff.
Well, congrats on your successful capital raise recently. You guys are doing a lot of interesting stuff. So I share that with you as well.
We're trying. Come see us.
I will, definitely.
All right. Talk to you soon.
All right.
Thanks, everybody.